Liberation Day is upon us. So, Liberation Day has passed and it came with fireworks. Overall, great news for the mortgage industry. We saw interest rates move down quite a bit. And we want to break down Liberation Day and how it can play effect into the mortgage industry. So if you're not familiar, Liberation Day was a term coined by the Trump administration for reciprocal tariffs being placed on other countries. So yesterday, we had reciprocal tariffs placed on other countries from 10% all the way up to 49%. And what this is this is a way to generate revenue. As of right now, we were not charging other countries reciprocal tariffs or tariffs to import goods in the United States, yet we get charged to export goods into their country. The reason why the U.S. didn't want to do this is they wanted to maintain a balance. They wanted to maintain good, domestic and foreign affairs, right? Things like that. So we weren't charging that. But Trump doesn't want to do that. He wants to increase the revenue of the U.S. We had nearly $1 trillion trade deficit for these tariffs. But this is new. We haven't been doing this, or we haven't done this in a while, so it comes with a lot of uncertainty. Remember, tariffs do two very important things to the U.S. economy. One, it adds the risk of inflation. Why does it add the risk of inflation? Well, if somebody is going to import goods into the U.S. and we are going to charge a tariff, a fee to import those goods, do you think the person importing that is going to just maintain the price at the same level? Of course they're not. They're going to increase their price to maintain their profit margins or to maintain that they can continue to, work at the same levels. So now you're going to see higher prices. And guess what? Those higher prices then filter in to the U.S. economy, the consumers, the businesses, and things like that. Obviously, again, the whole concept here is, hey, if we receive this revenue, then we can lower the taxes on the American taxpayer. So you may be paying a higher price, but taxes come down. We'll have to see how this plays out over the course of the next few months, few years. But as of right now, we're not seeing any signs of tariff inflation. Inflation, right now, Fed targets 2%. Today we're at 2.8. We know we're coming down to 2.5 on Thursday next week, right? As a week from today. So 2.8 to 2.5, and then guess what? Likely May 12th, we're going to fall from 2.5 to 2.3, something like that. So we're going to be right at that Fed target of 2%. Again, a major different conversation we're going to have 6 months from now. Will this start to filter into the economy? We don't know. We're going to have to wait and see. And if it does, that usually means the Fed has to increase interest rates to combat the inflation. So that's the risk. But what we're seeing right now is we're seeing the alternate effect right now. We're seeing the risk of a U.S. slowdown. That's the other fear of tariffs. Guess what? Prices go up. People don't want to buy. You see a slowdown in the U.S. economy. And we have our first signal of that, right? What's that first signal? The Atlanta Fed came out with Q1 GDP at negative 3.7%. Q4 GDP was 2.3%. We're at negative 3.7. That is a 6% swing in GDP in just one quarter, right? Wild. Again, there's a lot that goes in that, exports, imports, but still, we're seeing a slowdown. We'll have to see if it's actual consumer spending or just exports, imports when that data actually comes out. Remember, a recession is only 2 consecutive quarters of negative GDP growth. We're officially one in. So we'll see how Q2 goes in, and we'll see how this all plays out. But that's the risk. You're risking that economic slowdown by doing tariffs. And guess what? When you have an economic slowdown, you see that flight to safety. You see Treasury bonds come down, or you see Treasury yields come down, bonds are bought, and mortgage interest rates come down. So overall, we really don't know how this is going to play out over the next 3 to 6 months, but the initial reaction is positive for the mortgage industry by bringing down interest rates. Stay tuned. We'll be sure to report back over the next few weeks and months.